Hello, people. Another episode of Stockommon Cents. Forgive me, last week I went and had took the week off, but I am glad to be back. I'm glad to be back with you guys to talk about the market, talk about things that are currently going on and things that we do want to see. Sorry, my screen's overacting up. Things that we do want to see. So without further ado, let's go ahead and get started. Currently up on my screen is the S&P 500. Past 2 weeks, if you see these two bars, we did exactly what I thought we would do, which would be reject off of this line right here. I predicted that this would be one of the lows and that we would be able to shoot up, but the way we shot up these past 2 weeks have been extremely violent, very violent, and in a good way. So if you're holding a lot of long-term positions and that you were long in them, guess what? You made money. I know for myself and for others, we made a sizable amount of gains within our portfolio. Even sold off a couple of our options for profit. So, yeah, one of the ones that I typically like to sell within ranging markets is the SPY. Once again, this is not investment advice, but I just want to let you know how I'm playing this market, right? So as of right now, we wrote it up to 45, 43 after getting to as low as 42.04 2 weeks ago. Now, if you look, we are above the one of the resistance lines that I have over here. Now, there are two options that I do expect us to do, and it all falls because we are at the end of a quarter. Typically during the end of a quarter, you will see the market perform well, simply because you'll see clients, you'll see portfolios, you'll see hedge funds closing out of positions and trying to end the quarter strong so they can report to their customers. So that's why I had a very good guess that this would be able to shoot up. We're also coming out of OPEX week, where it would be the closing of contracts, and that happened here. That typically happens the third or quadruple witching, which is the closing of all futures, options, and rolling over into other contracts. This does tend to happen it happens every quarter, and it happens March, happens June, then September, and then December, which is very violent weeks, right? Because we're rolling contracts over into the next contract. That's why I had a very good estimated guess, and ended up paying off in our accounts. So what I'm watching to see if we're able to get past this level right over here. Let me put my cursor on so y'all can see. Oh, sorry. Place my cursor right over here. If you look, I am very much looking at this level over here. I want to see if we can get to 1700. But this violent rejection, whenever we got to these candles over here, was extremely violent, right? We dropped 1 week from 46.32 all the way down to 43.95, right? So we close above here. I do expect this to be ranging. I know I will be placing a couple of positions around the 4,600 mark, and watching to see how that performs, right? Again, I still believe the S&P 500 is in a ranging market. I do believe we'll get to around 50-50 year end, which is up here. But I'm just placing my positions and hoping that they pay off, right? Still a long year. We still have things going on like the midterm elections. We still have a war in Ukraine. We still have high rising inflation. We also have the yield curve possibly inverting, and I'll explain that later on in this video. But we definitely have a bunch of things going on. So yeah, 2022 will be a doozy compared to the prior 2 years where, things are just going up and up and up. So this is really going to make you a trader. So just have caution. Now, once again, that is the S&P 500. We are watching what happens next week. I'm not here to predict the market. I'm just here to give analysis. I'm supposed to trade off of what I know and not what I think will happen. Okay. So S&P 500, if we go to the Russell 2000, we were down for the week. We were down 1.92% from last week. So this is a drop. Now, with the Russell 2000, again, this is some of the small cap companies, the top 2,000 small cap companies. Now, if you look, we are within the range I expect us to be. So this is between around 2160 and 1960, right? What we want to see to consider this to be a bullish trend is for it to break through this resistance level right over here and see if it can rise all the way up once again. Now, because it is ranging, it gives me belief. Well, it does give me belief that this will be a pattern that we will be repeating and that we will be watching. So this is something that I am keeping on my radar, and I am watching a long term to see what we can do to break out of this. Now, for things that happen during the week, this will be the #1 topic until a ceasefire, until a resolution is brought upon us, and that is the Russia and Ukraine war. Once again, I like to stress this as much as I can, that I'm not a political expert. I will not pretend to be one. I'm not going to say anything that incriminates myself or says anything that is out of line. My job is just to report what is going on so you can have an idea of what's going on in the marketplace, because all economics take place within the market, or things of that sort, right? I don't know if I can speak English today. So as I stated before in prior episodes, this has an effect on all commodities, like soybeans, corn, nickel has shot up. Gas is the one that I keep covering every single week because it's important to our wallets. But because of this war, there are economic factors that affect us that we have to be able to keep up with what's going on overseas, as sad and depressing as it is, right? So just really high level, the US is still placing sanctions on Russia, with Joe Biden even going as far as calling Putin a war criminal. Again, I'm not going to get into that. I'm just pointing out what occurred. We have we have NATO still doing what they can to provide Ukraine support. We also have Russia telling NATO and the entire West that as we continue to keep equipping Ukraine with weapons and not military, but as we continue to support Ukraine, that it is continuing to drag along the fight, right? It does seem like Putin is not one to stop until he gets what he wants out of that region. And what he wants, I'm not too sure. I'm not sure a lot of people know, but he is going to continue his mission until he gets what he wants. So that is Ukraine. If I can move on to oil. Pulling up crude oil, it was able to pull back from 103, I'm sorry, it didn't pull back. It actually rose this week from 103 to 102 or to 112, right? The week before it did get to as high as 130. As you could tell, gas prices spiked 2 weeks ago, and it is slowly coming down. Now, I do believe that this will be we will continue this upward trend as long as the issues continue. I know the U.S. is working on measures with Saudi Arabia, with some countries in South America, some in Iran, to trying to pressure them to push up oil productivities, right? With Russia being one of the main exporters, with us cutting them out, within our oil supply, we are looking to other allies, I wouldn't say allies, but other countries to help boost our economy whenever it comes to oil. So that way we're not feeling the pressure of the spikes, right? I mean, at the beginning of the year, we opened up the year at $75, and we're currently at 112. That is a huge spike, a very huge spike. Let's look at the last time we were at these levels. We can go, I believe, 10 years. Go ahead and zoom out. Last time we were this high, it was in 2013, where we got to as high as 112. If we can go back even further, we got to as high as 147. Now, this is in 2008. This is where I got my first car. I'm not making a lot of money. I'm making, I think, $6.50 an hour, and gas is $4, right? Gas was $4 at the time. Now, this affected everything from the airlines, right? Because if you go and try to book a trip now, flights are way higher than they were pre-pandemic, yes, and even post-pandemic, right? That affects transportation, that affects trips being booked, that affects the transportation of food and commodities. All these costs are being passed down to the consumer, which means we will be tightening up our wallets and things of that sort. This is why this is pretty major, and you can see why the US is trying to detach themselves from oil and try to go to a more cleaner base, right? I just personally feel that because of this war, has kind of sped up our process to where, while we were moving towards that direction, it's now more of an effort, or now is being more emphasized to go towards cleaner energy. So that way we're having to rely less on these non-renewable energy sources, right? I know for myself and my family, our next vehicles, it has to be electric. It absolutely has to. But I just wanted to give you guys some context to see how, or last time we were at these levels, and you can kind of look back and see how that affected the economy, right? Because in 2008, we were in a recession, right? Just want to go ahead and point that out. We'll get back to that in a few. So that's oil. Moving on, this happened 2 weeks ago. I wanted to cover it during the episode that I had, but once again, I missed that episode. I went and took a week off. But Jerome Powell and the Federal Reserve went ahead and raised interest rates for the first time since 2018. Now, here's why that is important, right? Raising the Fed rates allows banks and other companies to increase their cash flow, right? Because now they're allowed to charge more. Same goes for home prices and lenders and things of that sort. This is pretty major. And the reason why we're doing this is to go ahead and tighten up the money supply. So to give you guys some context, during the recession, the last recession in 2020, we lowered rates to open up the free flow of money, right? With people not working, people losing jobs and unemployment at all-time levels, we lowered rates to keep the cash flow going outwards, to get the funds into people's hands, and to induce and to create more demand for people to keep spending their money. We wanted the money to continue to circulate. Now, with demand being at all-time highs, commodities and prices being at all-time high, and inflation being so high, to combat that, the Fed has to raise rates, which is the tightening of money, making things a little bit more expensive as far as lending and things of that sort. And what that's supposed to do is cut down demand and then make rates lower, or make prices lower for the everyday consumer, right? So the reason this is major is because while we were already at all-time highs whenever it came to inflation, the war then occurred, and now all commodities, beef, things of that sort, is higher. That is a major key, and as to why the Fed wants to go ahead and raise rates. Now, the difficult part about raising rates is you want to be able to raise rates, but in a way that doesn't shock the markets as much, right? Let me give you guys an example. If you were to look at the S&P 500, go ahead and pull it up. Zoom this out, and then we'll go to let's do a 3-year chart. So if you were to look during the time of Corona, we cut rates to all-time lows and the market continued to rise, right? Rates are still super low here. In the next year, in 2021, then we continue to rise. With inflation getting higher and the mention of cutting of rates, you can see how the market then starts to downturn immediately. We hit 48.18, mention of rates, and we start sliding down because we all knew in 2022 that rates would be rising. That's why you saw record numbers of home buyers or of new home sales because rates are low. More lending is going out because now you can get loans at a cheaper rate. Credit cards are lower as well. So the consumer is starting to spend. Even borrowing, like I know for Apple owns everything, and they were still borrowing because why would you use your own money? We can use other people's money and make a sizable return off of that, right? So the index that has hit the hardest. So once again, this is S&P 500. You can see it slide down. Now the sector that's hit the hardest whenever rates are rising or tend to come is technology funds and all growth stocks. Reason being is that when rates are risen or when rates and yields go higher, that does now mean that you can get a higher return for your money. Now, is it as high as tech stocks? No, but it is a guarantee because you're dealing with the government and bonds and, the rising of rates. So if I were to pull up the NASDAQ, you look at a 3-year chart, you can see how this was affected that much, right? Growth stocks, whenever rates go up, typically growth stocks go down. And you can see this within the S&P 500, right? Or I'm sorry, within the NASDAQ, that violent slide down from 1676, getting to as low as 12,942. Okay, this line right over here. These levels weren't hit until the last time they hit was in May of last year. Now, let's go ahead and look at the financial sector. So we can look at some stocks like, let's look at Citi, right? These are companies that benefit from rate hikes. So we have them sliding down as well, but they typically tend to benefit. Actually, let's do this. Let's go. I'm going to pull up a sector. Let's look at XLF, which is the S&P 500's financial sector, right? You can see from 2009 or 2021 that this sector has been considerably rising, with the companies that make up this sector being, let's pull this up. The top companies within this sector are Berkshire Hathaway, because they are an insurance company. You have JP Morgan, you have Bank of America, Wells Fargo, Morgan Stanley, Charles Schwab. You can see that there are some customers in here that are profiting, everything in the green that are profiting. So if you go back to this chart has held up, right? This chart has held up. While they did have a slide down going or opening the year from 39, they open the year at 39, and we are up for the year. But if you look at the NASDAQ, we are down from the start of the year, considerably down from the start of the year. Now, if you look at some fintech companies, let's look at Square, which is one of my picks for the year. You can see that they had a re-rating starting from the high of 289, getting to as low as 82. Now, they aren't affected, or you can't, they aren't, I'm not gonna say they aren't allowed. I'm trying to think of the most effective way to say this. Because they aren't licensed banks, right, or chartered banks, they are less likely to benefit from the rising of rates compared to your traditional banks like Morgan Stanley, like Bank of America, like Citi, things of that sort, right? This is just a fintech company. If we were to look at SoFi, which is also a fintech company, you can see the re-rating of this company, right? With them going public in basically beginning of December, getting to as high as 28 and then sliding down, getting to as low as 774, right? With a lot of companies moving out of fintech and moving towards back to traditional banking. That's why Fed rates are so important. And you can see the re-ratings and you can see the money flowing into that sector because they are now allowed to make more money off of these rates. So this will be a sector that we'll be watching. And I am currently invested in to capitalize off the raising rates. Now, if we go ahead and go to the KPI, the key performance indicators. Let's go ahead and start beginning of the week. I typically use Forex Factory to go to talk about the KPIs. We did have not Colin Powell, I'm sorry. We did have Fed Chair Powell speak this week. That shook up the markets a little bit. He also spoke again on Wednesday where he talked about how we will be expecting at least 6 to 7 rate hikes this year, and probably ranging between 1/4% to even 0.5% each time that they meet. So that will be important and will be something that we want to watch. We also have core durable goods orders. We had a forecast of at least 5% that ended up decreasing by 6%. Had unemployment claims also getting lower. So if we were to open up this chart, you can see that we reached our peak back in 2020 during the recession. And we've slowly been sliding down. Now, this is good for the economy because it shows that more people are being employed and are getting the jobs. So that is good that our actual numbers is lower than our forecasted number. That is really, really good. What else did I have? We also have new home sales. Where is that? Here we go. On Wednesday, we had new home sales, and this is a chart that I really wanted to show you guys. So we have, if you look during the recession, the number of new home sales were extremely high. This is something I talked about whenever we had low rates. Now, if you were to look, since the rising of rates, we have been sliding down. This is an indicator that's letting me know that we are slowing down as far as new home sales. And we have talked about in previous episodes that the market is extremely high. I do believe that we have topped out, and this will be a sector that I do watch to see how the market is doing, because we have the issue that we have is that at this time the demand was so high that it was causing prices to rise, right? I know just within our home that our equity increased by 120,000, right? Making our purchase that we made back in 2018 a very profitable buy. Now, but it is pricing out new home buyers, people who have graduated and trying to get into a home. It does make it more expensive. On top of that, we have rising rates. So we're going from 2%, which was the average back in 2021 interest rates, moving all the way back up to at least 3.25, no, I'm sorry, 3.5% up to 4%, which is pre-pandemic levels. This is something that we will watch. I do expect it to lower the pricing of housing markets. And I don't believe we'll go back to, pre-pandemic levels, but I know the national average for new home purchases was around 500,000, if I remember. I know in Texas, I think we're around 350. But that new national average is at 500,000 to purchase a new home. Now, here's what I want to go ahead and show you guys. The last chart that I show you. I had a friend talk about the 10-2 Treasury yield. Now, every year since, I believe 2000, or no, not 2000, but I think it was 1967, this has shown, let me see. This is the yield spread between the 10-year Treasury rate and the 2-year Treasury rate. So here's what this means in plain English. Typically, the 10-year Treasury yield, which is the guarantee that you can receive by letting the government borrow funds from you, is usually higher than the 2-year Treasury, right? I mean, it makes sense. If I let the government borrow my money for 10 years, the rate I should receive should be higher than if I let the government borrow for 2 years, right? Now, if you were to look, anytime that yield is inverted, we have had a recession. Now, last time we had this inverted was in August 2019. And the recession typically occurs between 6 months to 24 months. Now, what happened right after? In 2020, we had a recession due to the coronavirus, right? This yield curve has predicted every recession from 1955 all the way to 2018. And I want to point that out because if you look here, we are approaching negative status. Now, do I think we'll get there? I don't know. But every indication shows that a recession is coming due to inflation being as high as 7%. We do have the yield curve getting close to inverting. And it's just one of those things that we just watch. Let's see if I can make this one wider if possible. Let me try this. We can go max. So last time it inverted, we had a recession. Last time it inverted on this end, we had a recession. And so you see, you can literally trace this back to 2000, right? Had a recession. This is around the time we went to the war. Or I'm sorry, not the war, but we had 9/11. We also had a recession, and we also had another inverse. That was 2008 that Obama had to tackle. And again, 2019 with coronavirus happening. Now, if we invert, you can bet your bottom dollar that we will have a recession. When it comes, once again, that'll be between 6 months and 24 months. But that is something that we are currently watching to see if we are able to cross. So just want to go ahead and show you guys, because you guys will be hearing it in the news and the articles about the 10-2 yield curve and how that will affect things moving forward. So now for the stock of the week, I'm gonna go past this pretty quick because I am running short on time. Stock of the week is Merck. This is a healthcare company, or global healthcare company. It offers health solutions through its prescriptions of medicine, vaccines, biologic therapies, and animal health productions. It operates in two segments: pharmaceutical and animal health. The company's pharmaceutical segment includes human health pharmaceuticals and vaccines. The company sells these human health pharmaceutical products primarily to drug wholesalers, retailers, hospitals, government agencies, and managed healthcare, while the animal segment develops, manufactures, and markets a wide range of veterinary pharmaceuticals and vaccine products. Now, it is also the fifth largest pharmaceutical in the healthcare sector, following Johnson & Johnson, Pfizer, Eli Lilly, and Roche Holdings. Within the past, let's go ahead and widen this out so you guys can have context. Within the past year, the stock has been up 7.1%. 2 years has been up 10.2%. 5 years, 23.5%. But it's currently down around 11% from the high of this, or from its last high. So its last all-time high was 92.64, and we last approached it back in November 2021, where we got to as high as $91. We have slid down since then, currently closing at 81.34. But if you look, this is a steady company being led by a Black man, which makes me super happy. Kenneth C. Frazier. He started working at Merck back in 1992. I'm going to pull up a picture for you guys so you guys can see this Black man. Kenneth C. Frazier. Go ahead and look at him while I talk about him. He started working at Merck in 1992 and became CEO in 2011. He is also the chairman of the board in July of 2021. He is a Harvard law student and ended up receiving in 2018 the Harvard School of Law Association Award, named one of the world's greatest leaders by Fortune magazine. Yeah, sorry. Was reading something. They have had a positive OI for the past 5 years. If I go ahead and pull up their financials. I'll pull up the income statement. They have had a positive OI for the past 5 years, with the highest amount being in 2021 as we were getting out of the pandemic, getting to as high as $12.5 billion. So once again, OI is revenue minus their expenses. So the amount that they were able to keep, with 2021 being their highest revenue year, bringing in $48.7 billion, right? In 2021, or December 2021, the FDA approved a oral treatment for COVID that lowers death or serious injuries by 50%. So something that they will be rolling out. If we go ahead and talk about their analyst reports, for their base case, they are expected to come out around $93.44, with their bear case being $82, but their bull case being $107 within the next 12 months. So that is something that we will be watching within this company. Once again, this is Merck, which is a pharmaceutical company, a very large cap company that has been doing well within the past few years, and a stock for you to watch. Now, for the tip of the week, I want to talk about something that is not talked about a lot, and that is beta. Beta. And what beta is going to put up the real definition so you guys can see it. This is the measure in security volatility in relation to the S&P 500. This is really key, so I'm going to say it again. This is the measure in security volatility in relation to the S&P 500. Beta less than 1 means that security has been less volatile than the market. Beta greater than 1 means that the security price is more volatile than the market. So again, if it's less than 1, then it's less volatile than the market. If it's greater than 1, then it's more volatile than the market. Here's why this is extremely important, right? If you look, let's pull up the VIX. which is the volatility index, right? This is a measure that shows the volatility within the market, and anything above 20 is an elevated VIX market, which means that the market is moving more violently towards upwards or downwards. That also means there's less certainty within the market. We're currently at 2081. So if you look, we have been sliding down pull this up, with us being as high as $85. And this was around the pandemic, right? During the rise of the pandemic. Now, during the war or beginning 2021, you can see that we opened up the year at $17 and have been rising, got to as high as $37, right? Now we've been gradually going down, which means there's more certainty. We know what's going on. While we still do have the war and things of that sort, we are being able to grapple with the effects and things that are going on within the market. Now, when this is high, and let's pull up the SP 500 again. When this is high, you can see that the market is extremely more volatile, right? The market has been sliding down as we've been having elevated VIX levels. Do this. Sorry, my chart looking so ugly. You can see that we've been sliding down as the VIX has been rising, right? Now, for Tesla, using Tesla's example, their beta is 2.1. This means this is an extremely volatile company, right? Using the yellow line, or I'm sorry, using let's do a year-to-date chart, right? If you look for the S&P 500, there's this purple line. It has dropped year-to-date, hovering around what, -8 to 10%, right? Now, if you look at Tesla, because remember, the beta follows the S&P 500, right? It's relative to S&P 500. If you look, it has gone to as low as, or has dropped to as low as 33%, or 42%, I'm sorry, right? We opened the year down and has been gradually going down. Now, we have been rising the past few weeks, or past few days, but this is an extremely volatile chart in comparison to SP 500. So you can see why we have a beta of 2.1. So using this example, the market being down 10%, Tesla being down 33%, very volatile. Now that's currently at 2.1, right? Now, if we look at GameStop, one of some people's favorites, their beta is -1.6, -1.6. So if we were to look at their chart year to date, you can see that volatility as well, but it is, I mean, using this chart, you can see, okay, while the SP 500 is negative, they are positive for the year. They are positive for the year. Now let's look at a less beta chart. So let's look at Coca-Cola, I believe. So they're negative, or I'm sorry, they're below 1. So they're at 0.7. So if we were to look at their chart, the S&P 500 being this chart over here, or being this line over here in purple, right? They have had success compared to the market. Success compared to the market. So while everyone has been down and everyone freaking out, they've been between, look, 3%, we have 4%, getting as high as 5%, right? Making all these gains while everyone has been going down. This is a company that we talked about as one of our stocks of the week. And you can see that had you invested your money, you would be up at least 4 or close to 4%, whereas the market is still down 5%. This is something that I tend to place some of my clients in, some of these steady Eddie stocks, so like Coca-Cola. Let's look at, I believe, Kellogg's, right? Also a low beta. And if you look at their chart, look, steady Eddie. Now, while they have been down the past few days, this is a stock that's still outperforming the S&P 500. Outperforming the S&P 500. Because once again, low beta. These are stocks that you can use to hedge against the market whenever things are going down. It doesn't mean that the stock won't go down, but it has a lower probability of going down compared to the market because of its low beta. Now, I want to go ahead and show you guys that, because I did have some calls from some of my clients wondering, hey, you know, the market is going down. What can we do to hedge? What companies could we invest in? And I suggested some low beta companies for them to kind of place their money in while the market is going through the correction. So something to think about. Once again, this is Stockommon Cents. I wanted to show this. I wanted to give this to you guys so you had something to chew on for the week. I will be back next week to give you guys more tips, to give you guys more charts and data for you guys to digest. And once again, this is just a way to make you guys better traders. Now, I will go ahead and shoot this out for those who stay to the end of the video. I will be having a 50% off sale for the week. This will occur from the 27th until the 2nd, where all of my products, all of my services will be 50% off. So for example, for the Stock Club, which is currently $75 per month, it will drop down to around $35 per month. I also have my stock watch list, which is currently going for $10. It will be $5. I am offering this for the week to make up for the missed Stockommon Cents. So if you stay towards the end of this episode, make sure to tell a friend so we can continue to become better investors, become better traders, and to increase our knowledge within the stock market. So thank you guys once again. Thank you for staying for the end of the episode, and I hope I was able to make you guys proud. So see you guys next week. Talk to you guys later.